Good afternoon, everyone. This is a special meeting of the CERS Investment Committee. We have a relatively short agenda for this afternoon's meeting. It's basically a special meeting to deal with an issue that has arisen that we need. It's a timely issue that we need to focus on this afternoon because we need a decision so that staff can move ahead either way based upon our discussion and decision that we're going to be making during this meeting. Basically, the question is regarding a decision whether we continue with our current investment with Kane Anderson and go into their continuation fund, or whether we decide to liquidate our financial holdings with that fund. And we'll talk about that in some detail. But first of all, we might begin with the opening statement. And Eric, will you present that, please?
No problem. This is a special meeting of the County Employees Retirement System Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If the connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sherry, would you do the roll call, please?
Yes, sir. Dr. Hackbart,
Here.
Mr. Cheatham,
Here.
Dr. Milkman, Mr. O'Mara,
Here.
and Ms. Pendergrass.
Here.
Thank you.
Thank you, Sherry. Are there any public comments to share?
No, sir, no public comments for today.
Good. Well, as I mentioned, we're going to have this relatively focused meeting this afternoon. It's basically a question of whether we continue with a continuation fund that's being created by Kane Anderson. Is a form we've been working with them and have been invested with them for some period of time, but we have the opportunity to either liquidate our investment or to fold into a new continuation fund, which they are proposing. The challenge we face today is that we need to have an answer back to them by the 24th, later this week. And therefore, our decision and a recommendation will be based upon that time zone. Given the time zone, we basically will not be holding a CERS board meeting, which would normally be held after our discussion and our recommendation because of the exigent circumstances. In effect, the decision that we make here with our investment committee will provide guidance for the staff to proceed with either a liquidation or to decide to continue with the Kane Anderson and fold into their continuation fund. Steve and Anthony will be presenting the general concept in more detail, along with maybe some of our history with that fund, as well as our current funding investment level and things of details of that nature. And will also be able to share with us their due diligence on this particular question. So I'd like to turn the program over to Steve and Anthony. Appreciate the work that you've been putting in to help us make this decision. And so the floor is yours.
Well, thank you, Dr. Hackbart. Good afternoon. We appreciate everyone's time to allow us to present this investment opportunity, especially on such short notice. And as I've done in previous meetings, I also wanted to thank Sherry specifically for such a great job in coordinating this meeting, along with all of the other meetings we've requested of her. She's done a great job. It's herding cats at times, but we appreciate all the effort. As Dr. Hackbart mentioned, this is a timing-sensitive investment recommendation and decision, and we understand that timing and short election deadline, while maybe not ideal, unfortunately is not something we or other LPs directly control for these private asset classes, and is often at the discretion of the GP or general partner. As you're aware, the portfolios are currently invested in the Kane Anderson Energy Fund 7, which is a 2015 vintage private equity fund. As we've discussed on several occasions, a major headwind in the private equity markets has been the significant slowdown in realizations over the last several years, which has been exacerbated more recently by the significant rise in yields. And private equity managers have begun to pursue alternatives to traditional exits, including continuation vehicles such as this, in an effort to offer investors, especially in older vintage funds, options for liquidity. We do expect to see more of these types of transactions in the future. And so we're trying to make accommodations for how we handle it as a staff and how we can provide as much lead time as possible, obviously to schedule meetings and for the investment committee and the board to do their proper due diligence. Kane has offered investors in their existing private equity funds the option of either one, selling 100% of their indirect interest in Kraken Resources LLC. This is an investment that's held across multiple Kane funds, or option two, retaining 100% of their indirect interest in Kraken Resources LLC through an investment in the KEPE Continuation Fund. And just to clarify, this investment represents approximately 40% of Fund 7. Anthony, you can correct me on that, but I believe it's approximately 40% of Fund 7, which we are invested in. And the election is either to receive that 40% essentially in cash, or to roll that exposure on a dollar for dollar basis into this new continuation fund. So it's not a commitment of additional or new capital. The exposure to Kane would be the same with the reduction of if we took the continuation vehicle, our exposure would remain the same. If we elect the cash option, it would be reduced by about 40%. Excuse me. When we evaluate these types of transactions or proposals, we consider a number of different characteristics and factors. One is the manager. We obviously did a lot of initial due diligence back when we elected to our initial investment in Fund 7. We continue to do ongoing due diligence. They've done a very good job of navigating what was a difficult market. If we look back to the time frame when Fund 7 started, some of the early investments and the oil and gas marketplace at that time, it was a very challenging market for these types of investments, and they've done a very good job of navigating that and producing strong performance, certainly over the last several years. We also evaluate the quality of the asset or assets that are being rolled into the continuation vehicle. Would we want to independently invest in that asset or that pool of assets on a prospective basis? We also consider the economics of the transactions. And importantly, in these types of transactions, we have to evaluate the pricing of the liquidity options. It's somewhat similar to taking a private investment to the secondary market. Oftentimes in continuation vehicles, the liquidity option is being offered at a discount to NAV, which is the case here. So what's the price of that liquidity? Is that price worth considering to take the cash option? And then we also look at the portfolio needs from a liquidity standpoint, as well as the potential risk-adjusted returns of the proposed investment relative to what we can see as the alternative investments available to portfolios or things that we're considering in our pipeline. Importantly, this investment currently resides, Fund 7 currently resides in our private equity portfolio, but for the continuation fund, it would be part of the fund's real return allocation. Again, it meets the criteria when we look at what we should be investing in that real return allocation. It has compelling economics, favorable standalone risk-adjusted returns, low return correlations to the current real return investments in the broader overall portfolio, provides a high degree of inflation sensitivity and meaningful diversification. It also provides a high level of yield and current income, which we think are important characteristics of real return investments. With that, I will turn it over to Anthony to provide details on the specific transaction.
I can ever unmute myself. Yes. Yes. Thanks for getting together on the short notice. It's been about 8-year-old asset for us, but I think what Kane did is they combined the interest in Fund 5. Fund 5, we're in Fund 7, and then Fund 8, we're all invested in Kraken entities, and they've merged those, but they're offering liquidity to folks in these funds. So the people who are still in Fund 5 have been in this for 12 years. Whether they want liquidity or not, this is the option that's been presented. And yeah, we found it a compelling asset because there's been a bit of a change, or these folks were running a strategy called the Energy Income Fund, and the fund that was originally committed to by some of our predecessors was the Kane Anderson Energy Private Equity Fund, and it was more focused on exploration and production, kind of more earlier stage things. This strategy is focused mainly on production. So these assets are gotten to scale and producing, and at this point sending back significant cash flows. So I think one thing to maybe to notice is on page for sure, I think for them it would be page 4. Let me show that. So then the blue numbers, you can see a lot just in the past 4 or 5 quarters, we've gotten a significant amount of cash back as the assets continue to produce. There's been a big change since 2020. They've made 3 significant acquisitions in the past 4 years, and also grown some organically, and that has allowed some significant production growth and cash flow return. So that's what explains the increase in realizations just the past several quarters. That's cash returned back. So 2/3 of the cost basis has been in about a year, and that is expected to continue. They've kind of constructed it since the shale wells decline rather rapidly. You need to have some things that are coming online, and then while others are still producing, you kind of have you don't have like a sharp drop off. They've constructed it so it kind of ladders on and continues to have production. The estimate they have is around 11 to 12 years of additional production still left in the current acreage. The current models that the Kane has run for this doesn't contemplate any additional acquisitions, but or growth from that. But if you go to page 2, Sherry, you can see on the color map, the yellow dots here are the Kraken assets. This is on the Montana and North Dakota border in the Bakken or the Williston Basin. And so there's definitely assets there, and they are well versed in the market, and you can see the different other color blocks. Some of those folks may have or perhaps will soon bring assets to market. So that is something that they are definitely considering. If you go to page 9. Obviously, for confidentiality purposes, it's not ideal to put exactly what these are, but sorry, share one more, I think. There. So there's several that are in the market or about to be, and so these are things they're considering and to be quite accretive. I think Steve mentioned how the private equity market has been a little bit frozen past couple of years with interest rates going up and the bid-ask spread kind of being wide for where buyers and sellers want to meet. Energy is actually one of the exceptions to that. There's been quite a lot of M&A activity and returns, perhaps because they've taken the medicine and the evaluation are quite low. So we're talking 2 to 4 to 5 times EBITDA multiples here. So not like the 10 to 12 or more that we've seen in PE. This is much lower now than it was during the heyday, maybe 8 to 10 years ago. So that's why another reason it's compelling, like Steve said, is a significant inflation ties. They're producing 80 to 90,000 barrels of oil equivalent a day. We're not running out of oil, but they are running out of cheaper oil because these assets tend to decline given the way these are produced, and so the easier ones, are and have been drilled out, and so the next set of things in the next few years will get more expensive, and obviously that will help. There is the risk, of course, mainly is the oil price bet. A sustained period of low oil prices would not, the cash flow models would not be as strong as expected, but it's mitigated by the fact that they hedge production. This is a production focused strategy. So for visibility, they hedge it out 3 or 4 years. So they have pretty clear visibility on the cash flows that are going to be coming in because they have set that. So this is not like a big oil price bet, like we need this to all go to 100 and then we can all have money. That's not what we're going for here. It's more like there are things that are producing. We can lock in prices and margins, and they are available relatively inexpensively, especially compared to history. And continuing on that with the management team that Kane has worked with for a long time is attractive, and also being aligned with them and not selling at a discount is extra.
Yeah, I think importantly, as Anthony mentioned, the alignment of interest. So they have an anchor
Mhm.
investor, and this is often the way
Mhm.
that the continuation vehicles, they need to secure a significant investor. But the GP as well is rolling their interest,
Mhm.
their carried interest, their actual interest, and they're actually increasing exposure. So they're cutting checks to increase their exposure to the CV fund.
Yeah, and the Energy Income Fund 3, they're the other remaining energy strategy that Kane has is also a buyer here. Yes, and if you look at funds 1 and 2 for that strategy, they are top decile, I think. I mean, granted, energy has been a tough place, but their strategy has been quite good because it's been focused on, more conservative, production focused strategy. And so this asset fits that, and that's why they were interested in having their current fund in the market be a purchaser as well. So I think that for a lot of reasons, we're interested in being on the side with them for that.
And specifically for the
Mhm.
new CV is the last page of the recommendation
Mhm.
has, it's a 5-year with 2-year
Mhm.
with 2 1-year extensions available, one at the GP discretion and one at the advisory committee consent. The expectation from staff as far as the modeling and the returns perspective, I think the base case is kind of where we price the investment. And there are a number of potential upsides to it. And that could be, as Anthony mentioned, there's a lot of activity in the basin. And this is a prime asset. Whether or not this actually goes out for 5 years or not, that's going to be dependent partially on market conditions, but it's a valuable asset that will probably get a lot of attention. It's a large producer, and there's some major players in the space that are, as Anthony mentioned, there's a couple of things that are coming to market, and this could be one that they could be in acquisition mode, increase and become more favorable economically, and become a bigger target for someone else for a different major player. So it's not, as Anthony mentioned earlier, there's several of the early strategies. These are very long in the tooth, very long, and some of those investors are looking for liquidity because they've, based on their pacing plans, they've made commitments to other funds, so they need to add liquidity. We're fortunate in that we're, as we mentioned several times, capital is dear currently. We're in a position where we both have liquidity and the ability to add additional exposure. And that's partially because we've been structurally short for a number of years on a risk reward basis. So we're in a good position to provide liquidity. So we're not a forced seller, especially a forced seller at a discounted price. So we think it's a compelling opportunity to continue our exposure to what we view as a really nice asset, and it's significant income production.
What's the best estimate of our value of our current holdings with the company?
So it's about, for Kraken,
Mhm.
it's about 20 to 25 million overall exposure to Kraken as part of Energy Fund 7.
Okay. It appears that in material that was distributed that kind of about $50 a barrel seems to be kind of the break-even point. Below that, return seems to drop off pretty aggressively, right? And above that, it's quite positive. Is that sort of your assessment?
Yeah, I think obviously there's sensitivity to oil, and I think that's right. That's kind of, in the modeling scenarios, pricing at different both gas and oil prices. I think that the upside certainly is if we see elevated prices. And to Anthony's point, though, this is a little unique with their strategy, and part of the change in strategy at Kane has been this the hedge commodity price risk that they implement, which adds a little bit less, offers some downside protection, also some certainty of cash flows that I think makes a lot of sense in the current environment.
Could you also review the cash flow associated with this investment? Do we actually receive cash flow on a quarterly basis or annual basis, or in effect, we are just sort of retained earnings with the company and that values our value of our investment?
Sure. It's what we mentioned on page 4. Sure, you can go back to that again.
Mhm.
So there you can see just the past several quarters, they've sent back, I think, so you can look fourth quarter, about 40 million,
Mhm.
30 million in 1Q, another 40 million in 2Q. So, I mean, they've sent real cash back. Yes, this is producing.
That's for the overall company. What about our situation?
This is to continue investing in that company, but only that
Okay.
company.
Okay, good, thank you. Mhm.
Mhm.
Could you also explain the discount if we were to liquidate?
Yes. What happens in these continuation vehicles, a lot of times, for some reason, the secondary market ends up being a lead buyer in these. I think perhaps because they're used to, they're okay with being not control. So Kane continues to retain control even as they sell a significant stake to these folks. So you may remember we did the toll road continuation vehicle recently. Similar thing. The buyers are not in control. They are putting up significant amounts of capital, but they're buying in, at a slight discount. Even that asset has performed great, but that's going to go off at maybe 97, 98. This is going to be at 85 because that is the best bid that Kane received. So that is what's happening, and they also get to reinvest at that rate. So it would say, every continuation vehicle is structured a little differently. I would say, based on how this one's been structured, it seems apparent that the buyers are really interested in buying. So they're quite aligned if you're on the buying side.
And so for the option 2, which is the cash option, it would be liquidation of essentially our exposure in Kraken as it's sold to the CV. And as Anthony mentioned, that comes at about a 15% discount. Part of that is there's a discount on the selling price to the CV, as well as the sellers bear the cost of the transaction. So all the transaction costs are borne by the sellers. Cash flows for that transaction, I think, would be spread out. There's an upfront and then deferred payments that could last in through 26. I think is what's modeled. They're not. It's not scheduled, but they would anticipate that full repayment would be received by the end of 26. So you would get an upfront payment that I think is roughly 50-something percent, 50 to 60% of the discounted NAV, and then deferred payments into 2026.
That's right.
Has KRS already considered this recommendation?
They have. They had an investment committee and a board meeting this morning. It was approved by the continuation vehicle was approved by the investment committee and ratified by the board.
Okay. Thank you.
You're welcome.
Other questions of Steve or Anthony?
Yeah, I've got a few. First off, the 25 million, I think, is, if I understand what I saw correctly, is the portion that you're talking about rolling over, correct?
That is correct.
What's our total exposure to this company? Not this part, but in totality.
Sure. The exposure at 630 is 56 million.
Okay. How much did we put with this company originally?
The commitment to the fund was 100 million.
Okay, so we only got half of it called. Is that?
No, it was all called.
It was all called. So all right. So how much have we collected in cash from it? We put 100 million in, and it's worth 56 now.
Yep, we received 54. Sorry, I'm just reading here. Let me double. I'd have to double all these. Let's see. We've invested 106, realized 54, unrealized 56. So just rough numbers.
Okay. Well, I guess that leads me to my next question. Were we in Fund 8, Fund 7, Fund what or are we
Fund 7?
We're in Fund 7.
Okay. If I'm reading this correctly,
hmm
on Wilshire on page 6, and Wilshire, if you're on here, if y'all want to address that, I see a net internal rate of return of 1%.
That's correct. The Fund 7 is marked at that right now. This is a change, like we said, there's a change in strategy. The vintage of this is not an optimal one for energy. It was quite overcapitalized in the mid 2010s, and obviously, as you know, there's been a big fall in the energy space, and a lot of folks have left, both from losses and from ESG reasons. So, you know, your generalists are all gone. Your Blackstones, Warburg Pincus's, other people who are all involved in the space, and then just other folks who aren't involved or not able to raise other funds. So it's gone from well overcapitalized during the shale boom to the exact opposite. There's probably not enough at this point. So that's part of it, and that's what you see here. So the 3 assets left in Fund 7 are what make up the rest of it. But yes, it has absorbed significant losses. So it's basically at a 1x. So the new team came in around 2020, and so that's when the Kraken asset has changed. You know, had the strategy also changed with the acquisitions and merging of things and production focus and scaling. So that's why it's gotten to the position where it is now. But yes, I wouldn't buy it on the past, obviously, and that strategy doesn't exist anymore. They only have the energy income strategy going forward. The original energy private equity strategy is no longer. Fund 8 was the last one that is not around anymore.
What was the original term of the investment?
Sure. Fund 7 expires on January 1st, 2026.
Okay, so roughly 15 months.
Correct.
And
So,
I understand this, we're going to be extending the term for with extension?
this is a 5-year vehicle for just purely only this asset, right? The other 2 main assets remain in Fund 7, and that term will end of next year. This would be as much as a 5-year term. Obviously, there's 2 1-year extensions that could happen. But like Steve was saying, yeah, this could probably be a full exit to another company, even as soon as the next couple of years, or they could be acquirers and then producing that and assembling that portfolio for sale would take a little bit longer. So,
Okay, so this portion of our funds, let me get my math right here.
Sure.
We assume our current value that we have with them was the 56 million
Correct.
total.
Yep.
So just under half of it will be extending another, let's just say 5 years.
Yes.
Correct.
Like 40%. 40% of it.
Okay.
Just to chime in, and this is John Patterson from Wilshire. Good afternoon, everyone. But just to chime in on what Anthony said, I think Kane has really done a great job of pivoting this asset over the past 10 years. This was more, to Anthony's point, an exploration, drilling type private equity investment at the initial investment in 2012. And over time, they've done a great job of deleveraging the business and turning this into a really nicely cash flowing business that is almost fully hedged as far as price goes for the next 3 to 5 years. So this is almost a very different asset than when it was originally purchased by Kane in 2012 with the first investment in Fund 5. And so, I think, the historic, the old nomenclature, historic performance is not an indicator of future returns. I think that may apply here as well. I think, this is an asset that, as positioned today, is much more attractive than what we have seen over the past 10 years in the upstream oil and gas market.
Well, based on your all's briefing on your sheet, it would have to be, because at this point, factoring in inflation, we've lost money on this deal. Is that fair to say or not? Am I missing something?
Oh, absolutely. I mean, opportunity cost wise, everything. Yeah, this basically, it's just been it's a break even. Yeah.
Well, and
Huge
that's
opportunity
across,
cost.
yeah, that's across the entire fund and not specific
Mhm.
necessarily to this asset
To
to
this one, that's
Kraken,
correct.
but
Mhm.
certainly for this fund,
I
yes.
understand that, but you know, we're in essence extending half our exposure for another 5-year period of time
Mhm.
with, you know, and I like this sector from an income perspective. Don't take me wrong here. I guess, and it's a conversation maybe for another day, but you know, I almost view this as hey, we're getting up to that 18-month part or that 15-month window when we could be getting our money back, and they found a way to lock us in for another 5 years or take a 15% hit. Okay.
Well, one thing I would note on that is, you know, Steve mentioned the alignment earlier. You know, one of the things when you're considering a continuation vehicle is always kind of the motivations and rationale for that continuation vehicle. And in this case, Kane was kind of up against it. They had a Fund 5 in which this is the last asset. They've extended that fund 5 times at this point. And you know, their investors are looking for liquidity. So what they did to try and make this right for Fund 7 and Fund 8 investors was they made the management fee on the continuation vehicle the equivalent to the management fee that you would be paying for this asset if it existed in the fund today over the next the rest of the life of the fund. So there will be no additional management fee for Kane here on this asset. So, you know, moving forward, your management fee will be equal to the management fee that you would have paid. A lot of times you see the managers that are kind of looking to get additional management fee to do these CVs. And so in this case, you know, we feel like the alignment is good. Kane's putting out more GP commit for this asset. And they're also, all the partners are rolling their carried interest, their incentive fees that they would achieve for Fund 5 and Fund 8. They're rolling their incentive fees into the new vehicle as well. So Kane is aligned with LPs in this new CV as well.
Okay. Of the assets that aren't being rolled over, what exactly are they left in?
So I would need to look at it, but I believe Kraken 2, which represents 40-ish% of the common equity of Kraken, I believe those are left in Fund 8 and the income and 2 of the income funds. But again, pro rata, these are going to be invested on the same terms as the CV, all in common equity. Everyone will have, Kane will have 85 to 90% ownership of the company. So there's no preferred waterfall for one fund or another.
So we do or don't anticipate these remaining assets to get wrapped up in similar scenarios we're dealing with today.
Are you talking about the remaining assets in Fund 7?
Correct.
Yeah, I think that's it's difficult to anticipate necessarily. I think they're looking for exits on those other assets. You know, I think they have not contemplated yet that they would consider it. You know, part of to John's point, part of the strategy here with the continuation vehicle is obviously they think this is in their opinion in our opinion as well, a very good asset. And they didn't want to sell it in the markets and not be able to realize some of the upside of the economics. They thought it was better for all investors to move it into the CV in order to unlock some of those economics. With the remaining assets, Anthony may be able to speak more to what those are, but they haven't contemplated yet that they would do that. So they would look for exits to those assets as well.
If I could ask a question, would it be accurate to say that we have an option of continuing an asset that is essentially break even or selling this asset at a 15% discount and taking a loss now? Is that accurate?
It's not break even, this asset. If you did sell, it would be you would have a double of your money, 2.1 net. The whole fund as a whole, Fund 7 is a break even. But we're
Okay.
talking strictly about Kraken Resources. That's it. There's 3 main companies left in Fund 7. This is one of them. So it's only that.
So Kraken has the potential to continue to throw off
Mhm.
more profit, or we could
Yes.
take a 15% loss now.
Yes. Correct. So you can see, you see how it's structured, like John was saying with the motivations. You're like, do I really, it's pretty clear where where the interests lie. But they're offering liquidity for people who want it. But
and specifically, not to to mince words, but so that it's a loss only in that you're selling it at a price less than the NAV where it was marked
Right.
at a point in time. But the Kraken within the fund itself has, to Anthony's point, even selling there is still doubled from the value. The value you would receive is still twice what was invested in Kraken originally within the overall Fund 7.
Sherry, if you go back to page 5, please, that table at the top.
Yep.
This is the total investments from both KRS and CERS.
No, this is just the marks for the fund itself, right? So the fund itself has an investment base of 229 million, realized 196. So as a Fund 7, I mean, we have our proportion of it, right? We were 100 million of like 2.1. So call it.
Yeah, because this is showing a 17% internal rate of return, and we expect that to continue.
I put 10 to 12 for conservatism, but I mean, it's done quite well. I mean, it's throwing off significant cash flow. I mean, you can see just over the past, 4 quarters. So 196 minus 81. So 100. So half the cost basis in 4 quarters, right? And that's continuing. We had to black out the numbers so you can see, but because they did a high yield issuance that's public. So, future numbers, let's say, are not, SEC has all their things about that. But let's just say there's expected to be a lot of cash flow continue to go forward.
So staff's recommendation is based on the notion that we could continue to perform positively over the next 5 years, as opposed to cashing out now.
Correct.
Thank you.
Yeah, I mean, in fact, if we were to, I mean, we even discussed with Kane the option of potentially upsizing our investment and getting more exposure to this asset, which it was not available to us. But I think the asset itself would at least warrant consideration, especially in given the pricing on it too, was worth the consideration of whether or not we could increase our exposure. Unfortunately, we can't. So our recommendation is to at least maintain the exposure and roll it into the continuation vehicle.
I would make a motion that we accept staff's recommendation to roll the current investment over into the continuation vehicle.
A second.
Dr. Hackworth, you're on mute.
Sorry about that. So we have the motion made and seconded to go with this staff's recommendation to move into the continuation fund. Any further discussion? If not, we can proceed to vote. All in favor of the recommendation to move to the continuation fund, please indicate by saying aye.
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 Opposed? Motion carried. One further clarification I think we need to just discuss, and that is, as was noted on the K side, both the investment committee and the full board approved this recommendation. I think the current plan is not to have a full CERS board meeting. And Lyle, if you have any input into that, or maybe Ed, if I think Ed's on by phone, just to kind of go over the kind of rationale for why will we not be holding a CERS board meeting to approve this recommendation.
Ed, you want to address that first?
Are you on, Ed?
It doesn't look like he is. No.
Yeah, he may chime in here in a second. I think in our discussions with Ed and Ed's conversations with Dr. Hackford, based on the current investment policy statement, it's not necessarily a ratification that is required. It's just an approval. So at this standpoint, I think at the meeting coming up on the 4th, we'll have some additional conversation with regard to issues like this that get brought up in pretty short order, and the best way to rectify that and put a mechanism in place in both probably the IPS and possibly the bylaws for these extraordinary circumstances that we apparently found ourselves in with this particular investment.
And that's a provision of our current policy statement. Is that's if I understand? Correct.
Yeah.
So we're in line with our current policy if we do not hold a full CERS board meeting to receive and consider and approve this recommendation.
I think Ed's available now.
Yes. Am I unmuted now?
Yes. You're on.
Okay. Dr. Hackbart, that's exactly correct. As Lyle stated, under our current IPS, there would be no necessary need for ratification. What the board had adopted by practice is that each recommendation by the investment committee would in fact be ratified, but the IPS didn't necessarily require that. Given the exigent circumstances that were present here, the need to meet very quickly to have a decision made, we made the determination that the investment committee could in fact itself make a determination, but that we would have for the November 4th board meeting, that we would have an explanation, if you will, of the exigent circumstances that existed to the entire board.
And that's essentially the fact that we have the October 24th deadline, right? And the inability to
yes,
have a full board meeting.
and the circumstances that surrounded that. Yes, sir.
Thank you, Ed. Okay. Is that clear for everyone? Any questions or comments?
Yeah, actually, John, are you still here? Or Craig, maybe. Yeah. Oh, yeah. Hey, John.
Yep, I'm here.
Do you mind opining a little bit? You probably see more CVs than we do. Can you just talk about the timing that tends to happen with these, and maybe the inability to necessarily anticipate? I mean, as LPAC members, maybe you find out a little bit, but maybe you could talk a little about how these dynamics usually are.
Yeah, it's often a quick process. Specifically in this case, they had already run a full process about 1.5 years ago. And so they didn't get the price that they were looking for, and just due to market conditions. So in this case, they already had 7 or 8 really interested parties for this asset that were pretty much lined up and ready to go at really the launch of this formal process. And so this even is probably a shorter fuse than what we see sometimes with other CVs. But these CVs, they can come without warning. Once a decision's made at the GP level, they get LPAC approval, the process is launched, and you're off to the races. So these can be fairly shortened processes, but in this case specifically, the process was basically already half done. when they kicked this off, a little bit ago. So.
Yeah. And Vicky's not on, but she was at the ILPA legal conference, and I think she had mentioned that there were some folks, her peers, who had seen some that, or a week. Oh, there, Vicky's here. So yeah,
I am on
So,
here. Yes. Yeah, at the ILPA LCON, the legal conference, they said that this is becoming really much more frequent, where there are continuation vehicles with a very short turnaround period within which to elect or not elect.
Yeah. And look, a lot of ways, this is not a thing we're a huge fan of. We're fine with the status quo option, and that's the best practice that ILPA has given. But unfortunately, we have to accrue this as a new investment because it's always a new vehicle. And so there's obviously costs in terms of time and diligence and legal around that. So we would prefer these not to happen, and we end up getting arbitraged a lot of these times, especially if we had to sell at a discount. But those are the choices we have. We don't get to dictate that.
Okay, good. So Steve and Anthony, I think it's your action going forward. With that, I think that completes our short agenda for this afternoon.
Well, thank you very much. Appreciate everyone's time.
Well,
Yes, thank you, everybody.